Rohr here with an early concise highlight on Thursday, February 12th, 2015. It's currently 7:40 a.m. U.S. Central Time. As you can tell, we're coming to you a bit later than usual because we wanted to wait until after the U.S. retail sales figure, and we'll be getting back to that in a moment. So, what does all this mean to the markets? Well, at least so far, maybe on the ceasefire in the Ukraine or further quantitative easing, the equities like it. We've been up to 2077.5 in the S&P, even after the U.S. retail sales being as weak as they were. We only have dipped down to about 2073 or so, so we're still up 7. Most importantly, we're out above that old 2060 important historic level from after the January release of non-farm payrolls, from which the market faded again due to the weak hourly earnings. And of course, Europe was the problem in the S&P pushing above 2060 last Friday, but then from lunchtime onward backing off into early this week. But as we've noted previous, that only brought a test on Monday, late on Monday, of the 2040 to 2036 area. That was also trend support and Fibonacci support, in addition to being classical internal congestion within the range. And the market has continued to push higher. The dip yesterday back down below 2060 to the Fibonacci level at 57. Once again, still couldn't break this upward channel. As we head out through today, what's interesting about that, when we get to the end of the day today, that channel is up to about 2064, so around where we finished last night, and quite a bit below where we're trading this morning. So in other words, later today into the closing time, we'd have to be back lower on the day to be breaking support. Of course, what this morning's gap higher opening will also do is put the hourly MACD back out above the upper runaway band. 30-minute MACD we suppose as well after a couple of time periods. So unless there's some further pressure fairly soon, the bulls may well grab control of this market again, with the ultimate hurdle being the 2088.70 all-time high from late December. If that's exceeded, there's not much above this market until well above 2100 due to the indications of the oscillators tying into that 2088.70. You'd be looking at something like 2120 before you'd top again. And after such a long breather, that would seem pretty reasonable. That pretty much does it for the short-term view of the S&P 500.